Yeah, well, it's kind of funny because I think Matt and I, we look at a lot of the same data, and I just tend to be, we agree on a lot, but I tend to be a little bit more bearish. But at the same time, that stuff I'm allocating to is the type of stuff that people say, well, why would you allocate that to that if you think a recession is coming? A lot of consumer discretionary, and I've been not going crazy, but increasing the allocation some consumer discretionary recently. That's really based on the fact that I think they're already pricing in a recession. And if you don't get one, they may have the ability to move significantly higher. And if stocks continue to move down, I think a lot of them have gotten hit so much that they were going to have a beta similar to the market, and they'll move down. They'll continue to move down, but you won't get that sort of high beta where they move down significantly more than the market. General Motors is one. You look at autos. There needs to be more. They definitely have a tailwind for production. Yes, pricing could be a headwind, but they continue to execute. It's a really challenging environment for autos and a lot of manufacturers. Their material prices, labor, supply chain, all that stuff's hitting them. And then you can still sort of reiterate your forecast, and you're trading at 6-7 times earnings in a tough environment. That to me is very attractive. And yes, maybe if the economy really rolls, you're going to get hit, and that 6 to 7 times earnings is a mirage, and it's more like 10 to 11. That would be in a shallow recession. If there's a deep recession, they'd get hit more than that, but it's still an incredible value. And even in bad times, to be trading maybe low double digits in an earnings multiple, the earnings multiple of the S&P is closer to 20. And so you look at some of these companies, consumer discretionary, and they're just hard priced for a recession. Absolutely. I mean, there's a company called Brunswick that I did a tiny allocation to this morning. They're the leader in boats and boats engines. I mean, they dominate the space. They took share. They're putting people out of business. You use Brunswick and their Mercury engines if you're in boating. Who the heck is going to buy a boating stock if we're going into a recession? And I'm thinking that. I'm well aware of that. But at the same time, you have a dominant company that's trading 6-7 times earnings. So even if the market hangs in there, they have the ability to soar if we avoid a recession. And so I look at those risk reward situations. Home builders obviously are facing a big challenge with mortgage rates and pricing affordability. At the same time, there are secular dynamics in play. Well, if a recession comes, actually with home builders, you're probably going to see the 10-year drop, the rate drop, and some of those stocks may actually go significantly higher if the recession comes, because the stock market's looking forward to beyond the recession. So I am definitely adding to consumer discretionary, and they're going to be volatile. These stocks are volatile, and we'll see what happens. But my bet is that some of these stocks only go down with the market. If the market continues to go down, and if we get some stabilization, they can go up 2 times what the market goes up.